Ryan Dents, g'day. How are you, mate?
Yeah, good, Greg. How are you?
Very well. It's been a while since we've had a chat, so I thought it'd be a good time to quickly get in contact and talk to the subscribers. We had a really big move in the crypto markets and Bitcoin in particular over the past few days, and of course that's had an impact on the interest rates that you can get in the crypto world. Let's talk about that a little bit. So first of all, the move in Bitcoin, it dipped below 30, looked like it was pretty hairy there for a while, and then it's just come roaring back. What do you make of it?
Yeah, so there's been a few ideas of why the Bitcoin price went up, and what tends to happen in crypto is every time there's a big price move, people Google it and they see, Elon Musk's tweeted something, and they try and pin it on one thing. And in this case, a lot of people tried to pin it on the fact that there was some reports that Amazon was looking to integrate Bitcoin payments. And they'd also advertised a position for like a cryptocurrency, lead in a job posting. I think that's a bit of a furphy in a way. Like people try and pin to one item of news, and that was there. But that job posting, for example, was there for a few days before the big price move. So I think that's just mainstream media trying to find a narrative to suit the price. What I tend to think happened was, and like you said, there was a few important moves on the price chart. So we had a third test of that 30K mark. It dipped under, and it looked like the sort of next move was going to be down. But then we had a bounce off that 30K mark, and for a few days it was creeping higher on pretty low volume. And then it got to around about 36K, which looked like a bit of a resistance point. Instead, there was a huge short squeeze. So basically, there was a bunch of people at around about that 36K betting on the price moving down or bouncing down from there. And instead, a bunch of buyers came in. And then these short sellers, so these people betting on the price going down, they were what's called naked short sellers. And that meant that they had to cover their position. And so they had to buy in a lot higher. And so there was a sort of a cascading effect where I think we were on a call on Monday morning and the price went from like 36K up to 40K in the half an hour we were on the call. And a lot of that was the short squeeze, people having to buy back in. But some of that would have been fundamental buyers coming in as well. So I think the fact that we didn't breach that 30K again, despite a lot of fear out there's a lot of negative news stories on crypto going around. One of the social sentiment gauges I follow has been in extreme fear for the past 6 weeks. And so in that environment, when the price does the opposite of the sentiment, that's usually a sign that the hands that are left are pretty strong, and the people that want to buy then have to up their prices to buy. And I think there was an element of that as well, because behind the scenes, there's a lot of progress going on in Bitcoin. There's a lot of new ETF applications every day, it seems. It only seems a matter of time before they sort of get approved. There was a couple of huge venture capital deals last week in the crypto space. One was an $18 billion deal. So it valued a cryptocurrency exchange called FTX.com. It valued that company at 18 billion. And a lot of the investors in that were, the who's who of tech investment over the past 20 years, like Andreessen Horowitz and people like that. And so to them to put a value on a cryptocurrency exchange at that high a valuation suggests that the people in the know are looking down the line. They're ignoring a lot of the negative headlines, and I think that all came together. Short squeeze was part of the short-term moves. We have had a little bit of a retrace today, down to around about 36K, but technically speaking, I think there's a convergence of factors which have resulted in potentially a worst case we go a bit sideways from now. It looks like the worst case scenarios of moving back into the lower 20Ks are gone, and the next step is either a resumption back up, and this will end up being a short-term correction, or we might get a period of sideways moves. But it definitely seems like this move's been powerful enough to suggest a little bit of a trend change in the price of Bitcoin.
Yeah, look, from my perspective, and I look at a lot of charts, and I sort of look at that very short-term break at 30,000. And often what happens when you get these breaks low, where everyone, and when I say everyone, everyone expects it to fall, maybe another 5,000 or even down to 20. When that doesn't happen, people then all of a sudden panic on the upside because they might have had this dry powder waiting for this fall to an area where they ideally want to buy. And when that doesn't happen, all of a sudden they're chasing it higher. So just from a technical charting perspective, I look at that very solid support starting to form at 30,000 now. There's still a fair bit of overhead resistance. So I sort of from a charting perspective, once again, wouldn't be getting too excited. I think there's still a bit of a downtrend in force, certainly from a medium term. But this rejection of 30,000, I think, just says that we're in this trading range, and it really supports the view that we've had for some time now, is that dollar cost averaging at this time is really the way to go to accumulate Bitcoin, because it takes away the guesswork of trying to sit on the sidelines and work out, hey, is it going to fall further or is it going to roar off? Like, who cares? Because in the longer term, it doesn't really matter as long as you're accumulating and doing it that way. I think that's the safest way to go.
And I think that's what your guest last week, Fozzie. So that excellent interview you had with Greg Foss. If you've not watched it, you should watch it. It was really good. I really enjoyed it. But that's the point he made. You know, if your allocation to Bitcoin or cryptocurrencies is 3% of your portfolio, don't split hairs over whether you're getting at 30K or 20K, because over a decent time horizon, it's not going to make a difference. That is going to look like a blip, you know, if things go.
Yeah, I think I was going to say that was the takeaway. One of the takeaways that I got from it, and it's a simple one. It's like, don't overthink it. You know, just don't worry too much if we're talking about, because it is volatile, and volatile assets make you tend to overthink it because you're worried about whether it's going to do this or that. Setting up a dollar cost averaging system is just the easiest way to do it, because it allows you not to overthink it, and you know you're still accumulating that way.
There was also another interesting little takeaway from this short squeeze as well, though, which is like if you put this moving comparison with, say, the gold market, for example, in that these short sellers of Bitcoin, the way they did it, so they were naked shorts. They posted collateral on some of these leveraged exchanges, but they posted collateral in the form of stablecoins, so like Tether or USDC, and then they used that as collateral to bet on to short Bitcoin. So essentially, they were naked in the sense that they didn't have cover if the Bitcoin price went up. And there was some, you know, maybe conspiracy theories saying it looked like a deliberate suppression strategy where people were, you know, certain players were trying to keep the Bitcoin price down. And, you know, this sounds a bit conspiratorial, but, you know, if you're trying to build up a position in Bitcoin, you want to keep the price below a certain point and maybe try and chip away at 30K and build up a position. And in other markets like gold, you know, potentially the paper market's that big that there's more room to potentially do stuff like that. I think the paper market is like 350 times the size of the spot gold market, which means that there's that disconnect between the spot price and the paper price, and it's hard for the spot price to lead the paper price. But in Bitcoin, because it's all on chain and because there's that on chain transparency, the spot price eventually does lead the market. So what happened here was, for example, is buyers came in and bought from exchanges and moved the Bitcoin off exchange. So you can see that they actually hold that Bitcoin, that's real Bitcoin being bought and moved. And that resulted in that short squeeze being a lot higher because the short sellers, they couldn't just keep on short selling and you wouldn't be sure, you know, if there was real Bitcoin there or not, because the source of truth was on chain. And so traders who were nimble could see the Bitcoin coming off chain by increasing amounts, and the short sellers would then naturally have to cover their positions. They couldn't fake it in maybe the same way you can with gold, for example, where the market's not so transparent. You never know who's really holding the gold. So I thought that was an interesting sort of, you know, that I probably went over that far too, you know, briefly and not enough complexity, but it's interesting that with an on-chain asset, the spot price will be the source of truth eventually, no matter what kind of games you try and play with derivatives.
I was going to say, I think a simple way to put it is that Wall Street can't really financialize Bitcoin so much as to constantly meddle with the price and play those games with it. So it just opens it, and what we've talked about before, it's just a far more transparent asset. It's very hard to play games with. So it makes it, that's a strong
and that's
point.
why we say to people as well to self-custody your Bitcoins, hold it in your own wallet, because once it's in your own wallet, it's not in an exchange where, you know, it's, no one knows whose Bitcoin is whose.
No one's lending it out. No one's using it.
Correct.
Exactly.
Yeah, it's self-custodied, and that's such an important part of the Bitcoin network, which let's face it, you don't get that with any other financial asset. If you've got shares, they're held with a custodian. Like you said, they can be lent out. Like there was a story I read earlier this year about super funds lending out shares to make extra money because they hold so many shares. They can lend them out to, you know, other brokers that want to short sell, and they can make a bit of money there. The shares were just sitting there anyway, so why not? But that introduces a whole lot of perverse incentives when that happens, when other people are playing with your assets. And with crypto and Bitcoin, that self-custodial nature of it, yes, it comes with some hassles and, being responsible for it. But at the same time, that is such a game-changing aspect of the new financial system where you're ultimately in control of what happens with your assets. And to me, that is a lot better system.
Absolutely. And that just goes to the point of what we talk about quite often, is that the middleman in the traditional financial system has the ability to make additional dollars on your assets.
That was the Robin Hood, wasn't it? That was what was happening with Robin Hood. They were selling order flow. They were doing all sorts of things to Citadel, to one of their early backers. And that's the current system. And, it makes me sort of, not annoyed, but when people criticize crypto, and it's not perfect by any means, it's a work in progress. There's things wrong with cryptocurrencies as well. But when people criticize it, but they criticize the old system as well, I sort of wonder, well, where do they want to go? This is an opportunity to change that old system. Yes, it's got problems and there's things to resolve, and it's a work in progress, but that's technology for you. That's how technology works. But if they don't like the old system and they see all these inefficiencies, and yet they want to give crypto a hard time and be the constant skeptic, I sort of wonder, well, where do they see the answer being then? Because therefore there is no answer. Therefore we just hold our hands in the air and say, well, the old system's corrupt, but what can we do? So that's off on a tangent, but
no, it's exactly right. And well, I was going to say, just on that point, there has been, and I guess listeners may have been reading similar sort of things, but there's been increasing, I guess you'd say, criticism or concern about stablecoins. And obviously stablecoins are a key part of what we're talking about here in terms of our initial strategies of generating income from stablecoins. So let me just mention off the top of my head, the concerns about Tether and concerns about, is it USDC, what assets they're backed by. A lot of people are calling it a fraud. I think I saw a headline again this morning, same thing. Now, if you've been around in crypto for a while like you, this is not new news. You've been reading this on and off for 4 or 5 years now. So do you want to just sort of talk a little bit about what these concerns are with the stablecoins and why you're not particularly concerned by it?
Yeah. Okay. So the first point I would make is there's a lot of different types of stablecoin, and the stablecoin that is copying the most flack are the stablecoins like Tether or USDC, which essentially say that for every dollar of they issue, so every token they create worth $1, they have an actual dollar sitting elsewhere. And initially everyone presumed, well, they'll have $1 in a bank account. So for every dollar in a bank account, they'll have a dollar of that token, and they should equal 1 to 1. And that was the way a lot of these stable coins were explained at first. However, a lot of criticism has come at that because it's very hard to verify that the backing of, say, Tether actually has that amount of dollars elsewhere. And so over the years, that's been attacked, where people would say, how do we know that there's, $2 billion in a bank account to cover that $2 billion worth of Tether? And the accusation would there be that, Tether are just creating Tethers out of thin air and using it to pump up the Bitcoin price. And this was the accusations that came in around 2015, 16, a lot of the time. Now, what I find about stablecoin critics is that, generally speaking, there are people that don't like crypto to start off with. Therefore, when they look at stablecoins, they go to the worst possible answer straight away. And because there is no answer, because it is all people just guessing within parameters, then they just assume the worst, right? So that's the first point I would make. The second point I would make is that every financial product in the world has some level of opaqueness in it, and we put some trust in that product. And sometimes that trust is fine, and sometimes it's not. And that goes with regulated products or any sort of financial product. I mean, if you Google fraudulent gold holdings, you'll find lots of different scandals where people claimed they had gold and they didn't, and they issued stuff on the back of it. If you look at the history of our banks over the last few years in terms of following regulatory practices, you find that there's levels of, I won't say dodginess, but there's levels of compliance within the banking framework that, sometimes isn't quite there. And whenever I say this, sometimes I'm accused of whataboutism, saying, oh yeah, but you're just saying, what about that? And I'm not. I'm just trying to lay out the framework that nothing is black and white. There's levels of gray and there's levels of what you can accept. And when it comes to stablecoin, that's exactly the same way I look at it. So what we found out in recent months, and this goes for Tether and USDC, is that their backing is not just money in a bank. It's money in a bank plus treasury bills, which is, debt owed to the US government, which is probably the safest form of debt, and also potentially commercial bonds as well. So the Tethers or the USDC tokens are backed by a range of bonds and cash-like assets, which is not much different from what you were saying is, a money market fund or something like that. And why do they do that? Why don't they just put it in a bank account then? Well, they do that for two reasons. The first reason is that Tether and USDC are businesses. So they've got costs to cover, they've got staff to pay, they've got technology to look at. And so the more margin they can make with interest, well, that helps them cover the costs and make a profit. And USDC, for example, is looking at listing on the stock exchange. They've got partnerships with Visa and that. So these are businesses that, are making inroads into the mainstream. The second reason, and this is specifically around Tether, why Tether shies away from US banks, is that historically, the US was very unfriendly to cryptocurrency companies, all sorts of cryptocurrency companies. And Tether was the first stable coin to really make a move in about 2015. And so in the early days, it wasn't possible for Tether to use US banks because the regulatory situation just wouldn't allow it. And I think Tether went through a process of using offshore banks. And then they realized that having all that money in an offshore bank was a risk in itself. So they came up with the concept of spreading across different assets, which would, in their way of thinking, from an adversarial point of view, is spreading the risk of government intervention, because Tether is sort of designed to be a decentralized stable coin that is censorship resistant. So that was always the intention of Tether. And so it cops a lot of flack because it doesn't want to be part of the US system, and it's made no secret of that. And because of that, everyone says, well, you must be dodgy. Whereas I tend to think the more rational explanation is that they are legitimately worried about the US government's regulatory system, and they want to be an international US dollar stablecoin. And so they've gone through that strategy of doing it. And again, this is all just my opinion, but the sort of chief technology officer and the CFO of Tether, they seem to be very well trusted by certain people in the Bitcoin community who I trust to a degree. And that gives them some credibility in my eye. And I honestly think it looks like they're doing smoke and mirrors, but I think they're just thinking that their point of reference is the government is an adversary that we need to stay one step ahead of. And to people that hate crypto or hate Tether, that's must be fraud. But to people that look at it from a different angle of, well, how do you create a decentralized stablecoin system with assets that are backed but not within the reach of government? That's the angle Tether's taking, in my opinion.
I hope you enjoyed that preview from New Money Investor. To get access to the full video and much more, please click on the link below.